Imagine you're at a bustling stock exchange, the air thick with excitement. Traders shout orders, screens flash with numbers, and suddenly, a new company's name appears. It's an IPO. The moment a private company goes public, and everyone's wondering, is this the next big thing? Will early investors strike gold? Welcome to the Savvy Finance Corner YouTube channel. Wealth begins with knowledge. Today, we're diving into the world of initial public offerings, or IPOs. These events often capture headlines and investor imaginations, promising the allure of getting in on the ground floor of the next Amazon or Google. But before you rush to invest your hard-earned money, it's crucial to understand what IPOs really are, and why they're not always the golden ticket they're made out to be. Let's start with the basics. An IPO occurs when a private company decides to sell shares to the public for the first time, listing on a stock exchange. It's a significant milestone in a company's life, marking its transition from private to public ownership. But why do companies choose to go public? There are several reasons. First and foremost, it's about raising capital. Going public allows a company to access a vast pool of investors, potentially raising millions or even billions of dollars. This money can fuel expansion, pay off debts, or fund new projects that could propel the business to new heights. But it's not just about the money. An IPO also boosts a company's visibility and credibility. Being listed on a major stock exchange puts a company in the spotlight, attracting attention from investors, customers, and the media. This increased exposure can be invaluable for brand recognition and growth. Lastly, going public provides liquidity for founders and early investors. It gives them a chance to cash in on their hard work and investment, turning paper wealth into real money. Now, let's talk about the opportunities in the IPO market. One of the biggest draws is the chance to get in early on potentially high-growth companies. Think about those who invested in Amazon's IPO back in 1997 or Google's in 2004. If you put $1,000 into Amazon's IPO, it would be worth over $1.5 million today. Stories like these fuel the excitement around IPOs, creating a sense that there can't miss opportunities. This excitement often leads to a frenzy of media coverage and investor chatter. New stock stories capture our imagination, promising innovation and disruption. It's hard not to get caught up in the hype when everyone's talking about the next big thing. But here's where we need to pump the brakes and look at the risks and challenges. The truth is, many IPOs underperform after their initial launch. Companies often price their shares optimistically, and once the initial excitement fades, reality sets in. The stock price can drop, sometimes significantly. Market volatility is another factor to consider. In the first weeks after an IPO, stock prices can swing wildly as emotional buying and selling take precedence over fundamental analysis. This unpredictability can be nerve-wracking for investors. There's also the risk of overvaluation and speculative bubbles, especially in hot industries like tech. When expectations are sky-high, it's easy for companies to disappoint, leading to sharp price drops when results don't meet the hype. So, how can you evaluate an IPO before investing? Start by looking at the company's fundamentals. Examine revenue growth, profitability, debt levels, and cash flow. A company with strong fundamentals is more likely to weather the storms of public markets. Next, consider the industry. Is it growing or shrinking? How strong is the competition? A great company in a dying industry might struggle, while an average company in a booming sector could thrive. The management team is crucial to look at their experience, reputation, and track record. Strong leadership can make or break a company's ability to execute its strategy and navigate the challenges of being public. Pay attention to how the company plans to use the funds raised from the IPO. Are they investing in innovation and expansion, or just paying off debt? The former is generally a more positive sign for future growth. Finally, compare valuation metrics like price-to-earnings ratios or price-to-sales ratios with competitors. This can help you determine if the IPO is fairly priced or if it's being overhyped. Now, let's talk about some red flags to watch out for. Be wary of companies that have never turned a profit. While some businesses take time to become profitable, consistent losses can be a warning sign. Be skeptical of companies that rely heavily on hype instead of proven business models. If a company spends more time marketing itself than improving its product or service, that's cause for concern. Poor corporate governance or lack of transparency are also major red flags. Look for clear disclosures, strong accountability, and a clean legal record. Any issues in these areas should make you think twice. So, what's the best strategy for investing in IPOs? There are a few approaches to consider. A conservative investor might wait several months after the IPO to see how the stock stabilizes before making a decision. This reduces risk, but might mean missing out on initial gains. A balanced approach involves investing a small portion of your portfolio in IPOs while keeping most of your funds in safer, more established assets. This lets you participate in potential high-growth opportunities without putting too much at risk. For the more aggressive investor, buying at the IPO price and aiming for high returns can be tempting. But be prepared for the possibility of sharp losses. This strategy is best suited for experienced investors with a high tolerance for risk. As we wrap up, remember that while IPOs can be exciting, they require careful research and consideration. They offer potential for high returns, but they're not guaranteed wins. It's crucial to avoid emotional investing and stick to the fundamentals when making decisions. IPOs should complement, not replace, a long-term diversified portfolio. They can add a dash of growth potential to your investments, but they shouldn't be the main course. Before we go, I want to hear from you. Are there any upcoming IPOs you're particularly interested in? Drop a comment below and let's discuss. And if you found this video helpful, hit that subscribe button and ring the bell to stay updated on all things finance. Remember, knowledge is power when it comes to investing. Until next time, this is Savvy Finance Corner, helping you navigate the complex world of IPOs and beyond. Stay savvy and happy investing.